In the high-stake world of investing, even the most seasoned experts have taken missteps. In Confessions of Stock Market Wizards, author Safir Anand compiles the advice from India's top investors. In this masterclass, he shares lessons behind their trade.
So, hello and a very happy World Book Day to all our viewers. And with us today is our author Safir Anand. Most of you would know Safir as one of the top IP strategists in the world, but we also know that Safir is an investor too, heavily invested in the stock market. He is also somebody who loves behavioral science. And today we're going to talk about our book, Confessions of Stock Market Wizards. So the book came out in February. It went for a reprint in less than 2 weeks, Safir, as soon as it came. And the book has been consistently on Amazon's bestseller ranking. So that is more about the book. But of course, we have our author Safir today, and we will be in a conversation with Safir. We'll talk about stock market. We'll talk about mistakes. We'll talk about how he got 26 doyens, the rock stars of the stock market, all under one roof. How did he manage this feat? I think it's an impossible, almost an impossible task to get all these doyens under one roof for one book. So Safir, welcome aboard on this discussion on the World Book Day. So first question is, Safir, why did you decide to focus on this theme of mistakes? The stock market, as we know, is a place where there's never a dull moment. There are investors who talk about their prized possessions. Somebody will say, oh, I bought the stock at 2. This went up to 2,000, 20,000. Everyone will talk about the gains that they made, the money that they minted in the stock market. But how come there is no one who talks about their mistakes? And why did you decide to focus on this theme?
So happy World Book Day to all the listeners. And thank you, Sachin, for for arranging this podcast recording. I just wanted to share with you something very interesting, that ever since the book has come out, I have seen 3 other people now holding podcasts and doing write-ups, including in their newsletters, on errors of omission and commission, which are the substance of our book. So it's very nice that this subject is awakening. I felt that if I was to come and tell you that I bought a stock that has done exceptionally well, that information is quite useless for you, because you have not participated with me in the journey of the decision making when it was done and the benefits of where it has led to. What you're interested in is the process that you can follow to become a more informed and a more learned investor, and to sort of do well from where you start. And therefore, successes, while they are a part of life, they are not necessarily the only teachers. Mistakes teach us more. Particularly if we are able to avoid mistakes, then we inevitably end up having a better result as opposed to when we have disasters. So the purpose of the book was that when I, as a investor myself, came, to the thinking that I'm going to be doing a book on this subject, I realized many shortcomings. One, that the subject of risk, unfortunately, is never taught in schools and colleges. And when I talk about risk, I'm not only limiting it to investment risk, but also professional risk, to some extent even health, managing your family, friends, and every kind of risk that you can, look into. So I felt that it was important to go to certain people who had, done well in the market over a period of time. Therefore, one, they had the experience of many ups and downs. Secondly, they had braved through the downs in order to reach where they have. So therefore, they would have a much more widening perspective to share, rather than just to say that we bought something and we were successful. And third is the typical nuance of how we as individuals behave when things turn unfavorable, or as they say, when the winds are against us. So this book is a dedication to the pursuit of knowledge through behavioral science. It examines a lot of these ups and downs and carries a lot of wisdom from these 26 wizards in respect of the balance that is required to become a good thinker and thereafter to become a good investor.
No, absolutely. And talking of the wizards, Safir, I'll just uh, for our viewers, of course, I'll just read out some names: Samir Arora, Sanjoy Bhattacharya, Vikas Kemani, Devina Mehra, Atul Suri, Vijay Kedia, Ayush Mittal, Gautam Trivedi, and the list goes on and on and on and on. Now, tell me, these people, each of them have their own set of fan following. Each of them is managing, portfolios in the tune of 5,000s of or 10,000s of crores, tens of thousands of crores. They're extremely busy people. How difficult was it for you, A, to get all these names under one roof, B, to get their time to talk about their mistakes?
So first of all, I'd like to thank all the 26 that participated. I would also like to thank a few others who in principle had agreed to participate, but because of one reason or the other, including the fact that the book content became heavy, we could not include them, but they were equally meaningful. When I approached these names, my first criteria of selection was to find somebody, A, who had lasted for at least a minimum of 10 years, because I did not want to take somebody who was so recent to the investment cycle that the success was very recent and therefore they did not have much to talk in terms of drawdowns. The second point was that I wanted to take people from different parts of India, from different educational backgrounds, with different sort of thought processes. Like, for example, somebody is a large cap investor, somebody is a mid cap investor, somebody is a small cap investor, somebody has gone to one of the Ivy League colleges, and while somebody is literally dropped out of school and yet made a great success story. So the idea was that when a reader looks at the book, he should be able to resonate a part of himself in one of the fund managers or in a combination of fund managers. So therefore the variety. Now, insofar as excess was concerned, when I approached them, there were limitations which I must recognize. The limitation essentially was that now SEBI has a very strong system in place in respect of what these fund managers can speak about, etc. So therefore, the hesitation was there. But when they realized that the larger objective was education, and most of these things that they're speaking in the book are based upon their journeys, which are now in the past. Therefore, in that sense, it is a matter of record that they have already undergone this process and yet, remained at the top. They showed willingness. Then the question was that what kind of interviews we will do. For example, if I was to make it extremely stock specific, rather than ideology specific, then many of them would have said that, it could have just been a question of timing going wrong and not necessarily, and therefore a wrong outcome, which could have actually turned out right. But the ideology of why they narrowed down on a certain company or a certain sector, or what happened during COVID or subprime, or how they, for example, have a resounding board to correct their thought processes. There could be literally a case where somebody's on the yes side, and in the company somebody's on the no side, and then they have their own way of resonating and sort of combining it. And then even if they take a decision, they are not sure that the decision is going to work out the way it's desired. So, for example, what are the checks and balances in place to ensure that if the thought process goes wrong, they don't get dented. It's like getting a scar on your body, but not losing, your entire life in the pursuit of an idea. So they were very kind enough to me. Many of them also realized that because of the interaction that we've had on Twitter or the other forms of education that I've undertaken in different capacities, that this was a book that was meant for the betterment of many, and therefore they were gracious enough to contribute, and I'm truly grateful for their time and their contributions.
And then with the current market, given the current market volatility, so everyone is, almost on their tenterhooks. We don't know what President Trump might do tomorrow morning when he wakes up in the US. So given the volatility of the market, in general, of course, we know that there's a tariff war going on, even though there has been some respite by the American president. But Uh, Given the current volatility in the market, how relevant do you think our book is?
So the book is extremely relevant for many reasons. See, when we have drawdowns in our portfolio, which we will have from time and time again, we don't know how to react because, first of all, nobody likes to lose money, even if the loss is on paper. Secondly, we fear the fact that if we are losing, we are going to lose more. And to that extent, we want to save, every human being will want to save himself from a loss. The third point is that even if they arrive at a decision to mitigate the risk in any form, they do not know what to do. For example, it could be that you sell your winner just because optically you see that it has given you profits and you want to park those profits, but you remain comforted with your losers who are actually straining your portfolio, and you feel that no, they're below my purchase price and therefore I should now hang on because. So there is a notion in our mind that there is a real profit and loss, and there is a profit and loss which has not happened, although it has happened on paper, but it has not happened in reality because it was not converted into a loss. So what is the behavior? What kind of cycles have these people seen? For example, when prime happened, subprime happened, and the portfolios had a huge drawdown, why was there a unprecedented rally in the next few years? Similarly, for example, when COVID happened, which was an unprecedented event for almost all of us, and we were locked down and we didn't even have access to anything beyond basic groceries, forget about, going to office and travel and other things, then what was the turning factor? Is it that the drawdowns in the portfolio, let's assume there's a 50% drawdown in the portfolio is already priced in, and then everybody's in a state of panic, and whether in the panic there's opportunity, or for example, is that only a starting phase for a much bigger pain? So these people have shared those experiences, and I think one of the very key points which comes out in the book from the wisdom of all these wizards is that market is way more predictable in the longer term than it is on the shorter term. So the guidance of how you should stay the course becomes very relevant. Sometimes you may not buy or you may not sell, but even holding is a big decision. Holding is not an automatic decision, it is a decision of the mind. And how do you condition your mind to benefit from the circumstances are all captured in some of the anecdotes that they have shared. Also, how are the managements reacting? Because that is equally important. So they are not only attributing it to their behavioral science, but they're also attributing it to the capabilities of management. Because on one hand, if you say that a company has excellent management, but it cannot navigate the water when times are choppy, then you're not actually calling it a good management. So behavioral science is all around that. And I think one point which I would like to contribute, which is my observation, not necessarily that the 26 people contributed to it, but I did capture it in my own chapter, is that when you look at the markets, you are only looking at from the perspective of a sum total of decision makings, which means that if there is panic or there is euphoria, it is the sum total of everybody else, and that sum total sometimes end up being too much in excess. Because if it is the cardinal behavior of human beings to find solutions. We have found solutions for medical problems, including COVID. We have found solutions for subprime. There are policy makers around the world that will unite and find solutions. Even right now, when you're talking about Trump, there will be deliberations around the world and something will come out. So the human spirit itself is to find a solution and move on. And in adversity, there are opportunities. For example, if we talk about AI and we say that it is causing, say, for example, loss of jobs, at the same time, AI will create a new set of jobs. The point is that can you identify those opportunities and maximize your returns is some of the aspects that are touched upon from the wisdom of everybody who's contributed.
True. And one of the most fascinating things that I find across all these chapters and the interesting point of views of all these doyens was the issue of omission and commission. So mistakes of omission versus mistakes of commission. What's your point of view on these, and which according to you is more dangerous?
So when you omit to do something, it is less dangerous because you have opportunities to do something else. For example, if I omit to buy a particular stock that may end up eventually giving a very high return, I will buy something else, and even if I don't get that return, I will get some return which may be better than the opportunity cost of keeping the money idle, for example. But when you commit to something, you fall for a bias, because then you are basically try to discover good news around what you have done to sort of back your own thinking, rather than support a thought process as an example which could suggest that you are at fault. Human beings don't like to recognize very easily that they're at fault. And that could become a bigger trap, because one wrong decision could be like a pack of cards or a house of cards, where the entire deck can come falling down because of wrong decision. For example, if you bought a stock wrong and the price dips, and you are very convinced that it is right, then you will end up committing more money to that cause, not realizing the fact that you could be making a mistake. Whereas on the other hand, if it is going well, you basically get complacent and you start patting your back that it is doing well, without realizing the fact that there may be a need for reevaluation at every stage. So the action is not something which is static; it is dynamic, and which is why you have to be a thoughtful investor. Otherwise, you should go to professionals and ask them to manage your money.
Yeah. And what, according to you, in your observation, is what kind of mistakes happen more during a bull market? Do people do mistakes of commission more, or mistakes of omission more during a bull market?
I think they do mistakes of commission more. What happens is, first of all, FOMO sets in, that is fear of missing out. So what suddenly people will come to social media handles, or they will come to read newspapers, wherever, whatever the source of information. And when you read headlines that XYZ company has sold so much, they feel bad about it. So in order to sort of catch up the race, it is literally like if you have 100 yard race and somebody is is very proficient at running, and he's taken off, you can't feel bad about it, because he's supposed to be very good at what he's doing. If you try to run too fast, you may run out of breath and you may have a heart attack or some other serious implication. So what happens is that in that pursuit to try and get more returns, you end up buying lesser quality companies because they sound more dreamy. They will project to you the moon, and you will say, oh, the market cap is very little compared to where they can be, and you will assume that each one of them will become a leader. So a lot of junk is bought during the euphoric times, and a lot of quality is sold during market corrections.
True. And not to forget the WhatsApp groups that you get added without any notice, and then you start getting tips on WhatsApp groups. So plenty of shady groups at work during a bull market. That's my observation, of course. But bear markets are different. They shape you into into a resilient, into a resilient person, in my opinion. But what do you think can be the biggest mistake in a bear market?
The inability to recognize it can be a mistake, because capital always comes at a cost. Even if you have not borrowed money, hypothetically, that money, when parked into a bank, would have earned you something. So there is a cost of capital involved. Secondly, a bear market can completely tire you down, because if you read on a company and you are convinced and you like it and you buy it, and there is no action and the price keeps falling because of the behavior of the market, then the mind can get into a state of thinking, that it's not getting it right. And you can't be in a loser's mindset. You have to be in a winner's mindset. Optimism is very critical, but optimism cannot be also overdone, which basically means that you can't just think that because something has fallen from 300 to 200, it becomes an opportunity. It can still fall to 100. But does not mean that everything that falls from 300 to 200 will become, will head to 100. So it's a tiring situation, because the rewards are deferred, rather than in a bull market when you can buy, and because it goes up, you've got some amount of taste of success, and you sort of, remain motivated to find more. And the other part of it is that, if you are getting impacted at work, because sometimes bear market also come with economic cycles that can impact your work. For example, your company may not be doing well, or it may not be growing, or your salary may not be growing, or whatever reasons, then it has a greater impact in terms of deferring decision making, even in terms of spending, which effectively can catapult the bear market, because we are a consumption economy. So again, the question lies in and if you study the wealth of the world, it is actually always at 10%. It is almost different to even Pareto 80-20. 10% people will make money at the cost of 90. So it's very important to understand that during bear market, why are these 10% people amassing a lot of assets, such as financial assets, whereas we end up sort of discarding those assets at a time when we could, even if we don't have the money to buy, we could just lie low by just remaining invested. Because the long-term market has always compounded at a certain rate, and even if you miss a year or two, if that compounding comes back to that long-term average, you will do significantly better by staying the course.
Absolutely, and that reminds me, when you interview in your book, of course, there are many wizards in the book who say that there were inflection points during their career, during market, of course, a bear market, wherein they saw most or some of their colleagues leaving the stock market for good. Now, I mean, of course, everyone is affected differently, but do you see that every bear market has some casualties? I mean, of course, you would know with experience that every bear market has some casualties. People decide to leave the stock market for good. Is that a reality even today?
Yeah, it'll always happen, because that's how human temperament is, and which is why the book is on behavioral science. For example, because we had a correction in the last few months, the announcements that some people have stopped their SIPs. Now, actually, SIP is not supposed to be stopped when market corrects, because you will get more units for the same quantum of money. But that's all, and then they will end up topping their SIPs when the market goes up. I remember at one interview many years back, when Mr. Prashant Jain was heading HDFC, he said that, my problem is people give me more money at the tops of the market, but they don't give me the same money at the bottom of the market, whereas they can create a lot of wealth, which is why the distribution of wealth is unequal. It is not to do with unequal because of inherent nature. It is more to do with unequal behavioral nature. So they leave the market. Now, I can understand if somebody is leaving the market because he has a need for money. He has a marriage at his home, or he has to look at the education of somebody, or he has to take care of the medical. That is fine, because money is meant for a purpose. But to leave that market just because some index is plunged and headlines are showing all red, it doesn't really make sense, because that's not how the market has behaved over time.
And now I'm going to ask you a political question. We know that we are in. I mean, the market is of course recovering right now, but what do you think that the current government or governments ideally should do in a situation like ours, so that the market gets revival of some sorts?
See, there are two sides of this. One side is that the world is creating an opportunity for India, just because of the fact that we have differential tariff, at least as of today. We don't know what is happening every day, but as of today. The second part is that generally the world also doesn't want to put all their eggs in one basket. So China started with problems initially when the virus hit, and then other things happened, and then people said, oh, we don't want a repeat of this, so we must have a China plus one strategy. Some people chose India, some people chose Vietnam, depending upon what you were making. I mean, some people chose other parts of the world, etc. So it is inevitable that risk mitigation will play out, which means that somebody will benefit and somebody will lose. The question is that the guy who has to benefit has to produce quality at a reasonable price, because quality at a reasonable price will attract the attention of others. So I'll just give you an example. With the amount of turbulence that there is in the world, to think that, for example, defense budgets will be cut is not sounding very reasonable. I can expect any other cut, but I cannot understand why countries will not safeguard their own nationalist approach when the world is becoming like that. So you have to identify your own pockets. Now, if defense does well, defense can't do well for itself. For example, it has to buy certain things in order to produce.
Hmm.
And you will say, okay, those will be exempted. And then it has to basically cater to the needs of communicating, I mean, transporting those to locations. So something else will do well. And then you'll have to develop roads in order to ensure that the transport happens. So something else will do well. So you sit down logically, literally like in a state of meditation without disturbance, or just listen to some nice music, take a piece of paper and your favorite pen and sketch down where you think that the world could be in a few years. And the simpler it is, the better will be your investment process. The more complex it is, the more difficult will be your decision making. And if you are not sure, which is possible, then commit to investing over a period of time, because then even if it goes good, you will be rewarded, and if it goes bad, you'll be rewarded because you'll also be buying in phases. So then you're sort of improving your process rather towards a better outcome, rather than concentrating on an inevitable outcome through a bad process.
Hmm. And now that brings me uh, to to a tough question, apparently. And that tough question is, of course, uh, um, there are plenty of favorite chapters that I have in the book. Which one is your most favorite?
No, all. And I'm not trying to be diplomatic. I will explain to you why. Because, the correction that came out in the market towards the end of 2024 and now lasting for the last few months makes me realize that different people are committing different kind of mistakes, including me. For example, let me assume that the market corrects. Now, in that correction, say my stocks are, suppose they're down, say 20% or 25%. Now, at that state of mind, the correction has already been done to the extent of 25%. Therefore, to equate minus 25% to what I think or what I believe to be an oasis of safety, for example, by buying a consumer company, just because historically they may have reacted less, is not necessarily the optimal state of mind to be thinking, because there the disruption is happening for a different reason. The disruption may be happening because of new entrants and because of fast delivery, now facilitating the reach of many other things which were not historically within my reach. Today, for example, if I want to have Indore poha, or I want to have some, thing that comes out of, say,
Dal from Amritsar.
Surat, out of Surat, I can order it, and it's not the same world that we live in.
Yeah, yeah.
So one has to be mindful of all these things when evaluating. So I would rather revisit the companies that I liked earlier to see how badly are they disrupted. If the price
Mhm.
is supporting my decision to buy, then I will top up. But if I think my thesis itself is getting destroyed because of technology, for example, obsolescence, then I'm sorry, I have to move on.
And now, okay, now I think it's time to wrap up now, but I won't wrap up without asking you one question, which I always ask you. Where do you see the market trajectory in the next 6 months, 12 months from now?
See, let us assume that in 6 months the market doesn't do anything. That won't be bad, because the world is already assuming a lot of negatives. So assuming it remains constant, you will say fine, because you will get 6 months to accumulate based upon the your salary or your savings or wherever your sources of funds are. But if the market has a significant drawdown, then it may be a point of worry. Now, I personally don't feel that the market will have a significant drawdown, because there is activism of several global leaders in terms of what is happening. And similarly, the businesses will also readjust. I think the process of readjustment is faster today than it was many years back. So I feel that there will be a situation where I personally believe, and I'm only talking about myself, and I'm not a registered advisor, so it's not an advice to anybody. I've been only on the buying side right now.
Okay. Well, I follow you on Twitter, so I know you're buying every time there's a dip. You're buying every time there's a rise, so you're always buying.
No, on the contrary, if you see my tweets from August of 2024 till maybe January, my buying had slowed down significantly. In fact, I had sold some part of my portfolio. So it's not necessarily that I'm buying then. If I, for example, I always make a list. For example, if I have a list of stocks and I look at it just, for example, right now, and I see that, oh, they've already moved up in the month of March or April, then I'm not forced to take a decision, because I may be looking at something else then. But it's not as if I will chase them. they are not that that one person in your life that is inevitable. Stocks are not supposed to be emotional, and you're supposed to only look at them from a source of maximizing your returns, but not in a living relationship with them in perpetuity.
Absolutely, absolutely. On this note, Safir, we would like to stop the conversation here now and time to log off. But thank you so much for discussing a best-selling book, of course, and giving your words of wisdom to us. Thank you very much.
And I really hope the readers enjoy the book, because we've spent a considerable amount of effort and thought process in trying to keep it simple, which is very important. I wanted to avoid jargon. Secondly, in trying to bring in reality rather than more fictional and more esoteric terms around the book. And therefore, I believe that it should resonate and make a class of well-informed readers, which is the entire purpose of the book. And thirdly, we kept it extremely affordable. In fact, I have received more than 100 complaints that the book was underpriced from people who bought the book, saying that we don't understand why a hardcover book that features 26 legends is priced at this. And my answer is, if you get knowledge cheap, accept it.
Absolutely. And the idea is to go for as many reprints as possible. So we have already done one reprint. We're off to another reprint very soon, Safir. Thank you very much. It's been lovely chatting with you.
Likewise. Thank you.
Thank you.